Hey everybody, Boris Russell BK Forest. Welcome to the weekly technicals for the majors for Euro dollar, dollar yen, and pound dollar, Feb 25 to March 1, 2019. The tension is killing us. And what I mean by that is that the price has just essentially been stagnant in the majors for the past 2 weeks. We are in some of the tightest ranges I've seen in years. Generally, when you have such tight ranges, something is going to break one way or the other. And the market seems to be very much just simply waiting for some resolution, for somebody to take lead in determining whether the dollar or the anti-dollars are going to be leading into the next couple of months. As things stand right now, the euro range has compressed just down to a penny. It's really a 13-14 range, and the interesting thing is that neither side has been able to win. They've been trying to bring it down to below 13. They've been buyers underneath there. They've been trying to break it above 13, at least 13.70, and they've been sellers all the way across. So it's in a true state of equilibrium right now, as the market is just simply waiting for some fresh news to try to push things around one way or the other. Dollar yen, the same kind of a thing. It really has been struggling with this 111 level for not just 1 week, but for two. And the range here is incredibly compressed. We literally have not been able to travel more than a single yen for 2.5 weeks, I think, on the charts. We'll see that in just a second. The only exception to the rule has been cable, which really did break out above the 130. Remember, we talked about the idea that regardless of whatever is happening, the market is making a hardcore bet that a hard Brexit, no deal Brexit is off the table. And it really seems to be the basic true consensus view now. The critical question is just how much more juice there is in cable, as all of this infighting, as all of the splintering is going on in Labour and Tories right now, and the Brexit headlines just simply yank the pair up and down all day long. There's clearly an absolute desire to keep UK essentially within the EU, and then of course to maintain UK within the EU into some sort of a customs union. The big problem, of course, is that nobody really is quite certain as what the final deal is going to look like. But at very minimum, it doesn't look like they're just simply going to walk away in March. There's going to be a delay, even if it's a technical one. The market is definitely kind of priced that in, but it's looking for more positive signs that the Europeans can create some kind of a face-saving gesture on the Irish border, and that in fact, May can come back and bring it back to the Parliament and have a decent chance of at least passing it. So a lot is riding on this right now. But for now, cable, certainly the leader in terms of volatility, and still looks like it really wants to run at very minimum towards the 31, 32 handle as we go forward. The data this week, very, very mild. There's nothing truly earth-shattering. There's one U.S. release that is kind of interesting, but even that is going to be backward-looking. Let's take a look at the calendar, basically. So we have housing starts, which has been laggard. Housing has just been in essentially a quasi-recession in the U.S. for the last 6 months, and it doesn't look like it's really all the data in front of it has shown that housing is really starting to suffer. I think both from the cost basis, and ironically enough, we've had a big decline in rates yet, but it has not translated into any kind of an uptick in housing demand, because I think wages have not kept up and housing asset prices have continued to really outpace the demand. So housing starting to come down here, and that's definitely not that positive for the U.S. That's a Tuesday release. Consumer confidence, on the other hand, should be relatively positive. We had a big bounce in the University of Michigan, and I think after the trials and tribulations of the U.S. shutdown, the consumer may be feeling a little bit better as we go into the first quarter of the year. Then into Wednesday, a little bit of European data with economic confidence. All of that data has just been very moribund, but generally, when you look at the European data, the only thing you're looking for right now is a bottoming out process. You just don't want things to get worse. At this point, the market is expecting nothing positive out of Europe, just simply not things getting worse. Then a little bit more pending home sales, housing data, durable goods out of the U.S. And then later, I think, yeah, that's pretty much it. And then German CPI, which has actually been a little bit hotter. So we're getting this combination of mildly stronger price pressures in Europe. I think partly it's because, of course, the euro has declined a lot, so that's definitely having some inflationary impact on the euro. And we'll let the sirens go by. Just 1 second. Sorry about that, guys. But that really isn't having any kind of impact on monetary policy, so market is going to ignore it. There really is nothing on the European side here that could impact euro for more than 10 points one way or the other on the calendar. The one interesting event that everybody's going to be focused on even though it's backward looking and even though it's a very one-off event because of all the things that went down in the fourth quarter, is the fourth quarter GDP. The critical question here is I think the market expects a bad number. So the upside, the surprise here could be to the upside in the sense that if it's not as horrid as the market thinks, that certainly will be positive because the market is writing off the fourth quarter in the U.S. because of the government shutdown, which created lots and lots of consumer bearish movement, very, very bad retail sales print. And generally, the market is going to be looking, certainly looking like almost 1% lower than the quarter prior on the numbers. So if it comes in anywhere close to consensus, that'll be looked at as a win. If we get down to 2%, that's going to send off massive, massive red flags into the marketplace. It'll essentially assure the fact that the Fed is definitely not going to hike this year. And create all sorts of angst, I think amongst investors. So still pretty much going to be written off, I think, as a one-off event, but a really, truly negative print like around 2% will definitely be a big warning sign for the market. And then finally, I think into Friday, the more interesting data here is going to be the personal income, personal spending stuff, because, again, the only way U.S. economy begins to grow is if the consumer begins to spend, and there's still a massive disconnect between the growth of the GDP and the growth in wages, which is just maybe barely starting to catch up right now. We've had lots and lots of legislation in the U.S. that passed the minimum wage laws. They're finally making their way through the system, but it's very much at the bottom. There's still very, very reluctant, recalcitrant sort of payment schedules for anybody in the middle level of the employment sector, and that's why wages are just not really growing as fast as you think. And then finally, ISM manufacturing, we close up the week. This is really, I think, going to be a key look, not just in the U.S., but everywhere. My argument really economically going forward is that manufacturing and services and PMI data has to stabilize globally in order for the world to not begin to price in some sort of a global slowdown or recession. We've had a massive comeback in equity prices, assuming the worst is behind us. But if the data doesn't confirm that, you could see a very nice, very serious comeback in risk-off flows as we go forward. So the manufacturing and the services data, which is going to be coming up next week, all very critical for U.S. data sets. We'll see if that kind of stabilizes as we go forward. And then also U of Michigan, just to making sure that the consumer should be in relatively decent shape, but a dip in U of Michigan sentiment, again, will send off warning signs to the market that things are not quite as where they seem. So now moving into the charts, this is where it gets interesting. Look at the charts. The charts are just ridiculously tight. I mean, this is just an insanely tight range for the euro. We've had 3 straight days. What's frustrating for the bulls and definitely a massive warning sign. So this is why I have kind of a neutral stance on the euro rather than the bullish stance. We're still up. We're still off the lows. We still have a higher low here. But when you look at this, you have 3 consecutive days rejecting this 1370 level. We just can't get up. On the converse side, we also have 3 consecutive days where the buyers came in underneath the ahead of the 1300. But one way or the other, it's going to have to push. Essentially, right now, we need for bulls to really assert their dominance. You need to close above the 20 SMA, which really puts you at around 1375. If we can get that signal beginning of the week, that will provide a much stronger chance of the euro moving towards the 14 and perhaps even towards the 1500 level. That this is a true bottoming out process, and we have made it. If we start falling through the 1300, this is a failed rally, and it comes back down to a retest of the 1200. It really turns the tables so negatively on the euro because it now creates a series of lower highs, as you can see here, and it basically turns what is a mildly bullish structure right now into a pretty ugly bearish structure as we go forward. So very much a do or die situation for the euro this week. Going to be watching that very carefully. Now cable looks a lot stronger. Today's comeback was actually pretty impressive. Did you see this is the Friday comeback over here? Nice little doji candle here, but still cable also experiencing the same kind of a story. 3100 is really, really capping the move for the last 3 days. It feels like it wants to run through that, and if it does, it really opens up the run towards the 3200. But this is all essentially just gamesmanship right now, as everybody is waiting for the next situation to in many ways I would say it may be intricately involved if some sort of a Brexit understanding develops next week. It actually would be positive for both euro and cable, because remember, a negative Brexit scenario is very bad for both currencies. It's terrible for the economic development in the whole region. So for now, it remains mildly bullish. It was certainly the strong call last week. We were bullish cable, and it certainly was the right trade. Now it's clearly run into a little bit of resistance here, although the buyers continue to buy the dips here. And for now, you essentially trade. I would say if you're short-term trading, you trade against this low that we made today, which is 29.50. If that breaks down in the front part of the week, that's an ugly signal that the market is just simply giving up hope for now and could want to take it down back to 28s. And then yen is literally, has there been a currency? I think I tweeted out the other day, has this thing on? And it's really true. I mean, yen, this is essentially an EKG of a patient that's having in a coma. We've had like essentially 2 weeks of no movement whatsoever, right? We tried to take out the 1100s, and then we came right back down. And now the 110 is the 110 111 is this range that we've just simply been in pure non-movement in for quite a long time. Now, yen has these histories of just these very, very tight ranges with them, and then they break, and then we have lots and lots of strong movements. So I do think there's certainly potential here for us to break one way or the other. The critical question is, it's just not clear at all where. You have to let the market speak to you. If we take out the 111s and close above the 111s on a closing basis, that's a nice bullish sign, and we certainly have a chance now then to really ramp up continue this rally. Overall, it's still a positive rally. We're still above the 20 SMA. It still looks relatively good, but at this point, you need that signal to give you some confidence that this indeed is going to be an upward move. If we start failing here and start moving towards the 20 SMA, that's a very negative move. It looks like essentially a fail around the much larger 500 SMA and a move back down towards a test of the 108s. So that's how the majors shape up. It's been a couple of weeks of indecision, and we simply need to be patient and let the market tell us exactly which way it wants to go. Wish you guys the best of luck, the best trading. Boris Schlossberg, over and out.